3 reasons why you should invest in tactical asset allocation portfolio. I know it's not complicated, but it's really not. And if you have any amount of investable dollars, then you should take a chunk of that and put it in TAA portfolio. In this video, I will show you how simple it is to invest in TAA portfolio and why you should do it, starting right now. You might have heard of tactical asset allocation portfolio or strategic asset allocation portfolio. They both sound very complicated, and that's the industry jargon to make you afraid to ask questions so they can push some crap down your throat to invest your dollars in. But really, it's a lot simpler than that, and this video is about educating you on how to invest using TAA portfolio. Welcome everyone, my name is Ali Casey, and thank you for joining me on Stat Oasis channel, where we discuss finance, investing, algorithmic trading, and everything else in between, which includes tactical asset allocation portfolios. If you are new, make sure to subscribe and hit the notification bell so you don't miss any of the daily videos that I post on the channel. Also, it would be great if you can smash the like button and share the video with others, as this will help me, help Google, push this video to other traders, other investors, so they can get some value out of these wonderful videos. So first, let's start with a simple definition of TAA versus SAA. So SAA, Strategic Asset Allocation Portfolio, most likely you have heard of 60-40 portfolio, that's being 60 in stocks and 40 in bonds. Most likely, if you had any investable dollars in your bank account, you have come across this, where somebody will call you up and say, oh, Mr. So-and-so, we see you have money in your account, then let me offer you some investable product. Usually it's crappy product shoved down your throat because of commission that is offered to the whoever is calling you. It's total BS. That's all I can say. And that's when we get into tactical asset allocation portfolio. Now, tactical asset allocation portfolio have been there forever, available in hedge funds, and they used to charge 2% maintenance and 20% performance fees, but nowadays it's available for everyone like me, like you, to invest in it. And I actually have a big chunk of my investable dollars in tactical asset allocation portfolio. And today I will show you my favorite tool that I use to invest in TAA portfolio. But first, let me give you the 3 reasons why you need to be invested in TAA. Reason number 1 is systematic approach. So if you are in the financial markets, for sure there comes a time where a friend, a brother, a cousin, a colleague that came to you and say, oh, look at what I have achieved or my performance. Obviously at that point in time you are lacking the performance. That's why he's showing it to you to brag about the performance. So you don't want to be in that boat. You don't want to be in a situation where you are following somebody else's investment or the news, or you panic because you are in a drawdown. You need to be in a systematic approach. Reason number 2 is you want to be dynamically allocating funds to the best performing sector. So you don't want to have a strategic asset allocation portfolio, even the best one, let's say Ray Dalio's all-weather portfolio. It's really good. It outperforms the S&P 500 over long term. It has better key performance metrics in everything, in drawdown, in compound annual growth rate, but it's static, and that's why it limits the performance per year. So while it's much better than just investing in the S&P 500, but it really underperforms any TAA portfolio. Not any, but most of TAA portfolio. The number 3 that you need to be in tactical asset allocation portfolio is performance. Because it doesn't matter what asset class you pick to invest in, there will be some lost time in this asset class. So let's take, for example, the S&P 500. Since the year 2000 till the year 2012, nothing happens. It's a lost decade, and there is no performance gained from in that period. Take Japanese stock index. Nothing happened for the last 40 years. Take gold from 1980s till 2008, where again nothing happened. So if you happen to be in that asset for that period of time, then your money didn't do anything. In fact, your money lost because of inflation. Performance is actually the most important reason why you want to be in tactical asset allocation portfolio. Great, now that we know that tactical asset allocation portfolio is much better than strategic asset allocation, How do I invest in TAA portfolio? Which one do I pick? And now comes my favorite tool, where I don't want you to follow just one TAA portfolio because there are many. And if you go to SSRN, where there are white papers, peer-reviewed, I just type here asset allocation, and look, I have almost 4,000 results. So of course, it's going to be very hard for you to comb through these. So it's much better than to use a tool that simplifies things for you, which is AllocateSmartly. So AllocateSmartly focuses on tactical asset allocation portfolio research. And I will show you now what do they do. It's an excellent service, and it's online, and actually you can get in free, and you get access for 3 strategies and a sample model portfolio. And basically you get a taste of it, and then you can subscribe monthly. But if you subscribe yearly using my link below, you will get 32% off your yearly subscription. So AllocateSmartly have 60 plus strategies, and they increase that over time. Now, this is not their own strategies. These strategies picked up from something like SSRN. So they go and, for example, they click on this journal, and they go on and read it, and these journals are all white paper, so they are peer reviewed, so all the rules are clearly stated in them. And so they go about implementing those rules and building a model using their data, and they take everything into consideration, like time, commission, slippage, and so on and so forth, what ETF. And the nice thing is they use most liquid ETFs to implement that strategy. So sometimes strategies, they come from academic literature, so they are not, let's say, meant to be practically invested in. So AllocateSmartly take that, but uses only liquid ETF, so anybody can invest in that strategy. So here are all the strategy, and there is a matrix of them. You can add any column here, like longest drawdown, maximum current, Sortino, anything you can add to the columns here, and then you can sort based on that column. So for example, I can sort on Alta Performance Index, and for example, the Meta strategy is the best strategy in that term. But I can focus on maximum drawdown or compound annual growth rate, and so on and so forth. Now, in the beginning, I suggest you start easily. Let's say accelerated dual momentum. This is a very popular asset allocation portfolio, and if you just click on it, it will always be compared to the 60-40 benchmark. The 60-40 benchmark, the 60 stocks and 40 bonds. And if we switch to logarithmic scale, you can easily see the difference. So this one makes since 1970, of course, the performance is a huge difference. And then you can go down, and these are some of the KPIs. So this is the annualized return since 1970, maximum drawdown, also performance index, and so on and so forth. And then these are the drawdowns over the years. This is the allocation, and this is the monthly and yearly returns. And then you can see here something is called alternative trading days. So if you click on this, this would give you if you trade on the 7th, 8th, basically any day of the month. So the trading month has roughly between 20 to 22 trading days. The strategy trades once a month or even less, but you have to pick what day you're going to trade on. And they test every strategy at what's the performance on which day over the whole period. So in this case, since 1970. And then you can pick which trading day you want to follow the strategy, and it will actually signal to you that, okay, let's say you want to trade on the 20th trading day, then it will signal the change on the 20th day. And here you get the recent returns and, of course, the allocation. Of course, you can dig deeper. So, for example, this is the historical allocation. So since 1970, it will tell you what's the allocation been through, and then you can zoom in. So, for example, let's zoom in here, the 5 years, and we can see we spent in 2016, we spent 57% in the SPY and 25% in international small cap and 16% in long-term US treasuries, and so on and so forth. And then you can see the category that you spent in. Now, every strategy that comes into the database It usually comes with a blog talking about the strategy. So for example, this is the strategy and this is the blog about it, the rules specified and what did they do in their testing. So they are really thorough about each strategy that comes to the database. So this is great. I mean, you're not blindly following a strategy, although every strategy is based on a white paper that is peer reviewed. The data and the logic is free for everyone to check. They still do that basically on liquid ETFs, and they give you multiple choice on what day to trade it and to see the performance and then compare it with other strategies. They also have some static strategies like this one. This is the Ray Dalio all-weather portfolio, and we can see that compared to the 60-40 it's come really close. But look at this. This is the most important part, is the maximum drawdown 13.1, which of course raises the ALSA performance index to 1.8 versus 0.88 for the 60-40. Now, of course, you can compare strategies. So for example, here are the database of strategies, and you can pick any 5 strategies and then you can pick them side by side. Of course, you can see that in the screener, but here, let's say it's more detailed with the drawdown curves painted for all strategies. And then you have correlation metrics for all strategies. Of course, you can pick any strategy you want. Of course, the table is huge, so that's why they give you the option to limit the number of strategies. So for example, here I pick the top 8 strategies, and this is the correlation metrics between those 8 and the whole database. And then there is another way to look at correlation, which is the cluster analysis. And I love this. This is a new feature. And basically what it tells you is each branch, so for example, conventional tactical, will be less correlated with the primarily passive or the RPV, GTT, and bonds. And then inside this, the fast tactical will be less correlated with the slow tactical, and so on and so forth. So this would give you like a top-down view. Then there are other curves like risk versus return scatter plot. And basically what this tells you, it plots the annualized return versus volatility. And that's the standard deviation. So for example, here we see the accelerating dual momentum. It has the best annualized return, which is 16 point something annualized, but it's also have 14% standard deviation up and down. And of course, you can go all the way down to the USRP trend following, which is annualized at 6.3 with annual volatility of 5.2. So here, let's say you don't want to worry about anything else. You just want to trade one portfolio. And instead of trading the S&P 500, which roughly comes at around 7%, you can get, for example, this one, the permanent portfolio, which is 7.2%, but annual volatility of 6.5, which is half of that of the S&P 500. And then there is the ETF Alternative Table, which, like I mentioned, so they pick the most liquid ETF to trade every strategy. Even if the strategy picks a mutual fund or something else, let's say an index, AllocateSmartly team, they always implement the strategy using the most liquid ETF, like I mentioned, because they want to satisfy scale. But in any case, they give you alternatives. Now, this is not a complete alternative list, but it's a good start. So for example, if you don't want to trade the SPY, you can trade the IVV, VOO, VV, SCHX, and so on and so forth. So for each asset class, they have alternatives. So these are the asset classes: stocks and real estate, bonds, US bonds, international stocks and real estates and bonds, and then gold and commodities. And then each strategy, they show you what asset class it's in. So for example, all-weather portfolio trades the long-term US treasuries and the large cap, US large cap, and the intermediate US treasuries and gold and commodities. Now, all that is very good. In fact, like I mentioned, all of these strategies, except for I think 2 or 3 on the platform, they're all open. You can find the rules, you can test them yourself, and actually you can trade them yourself without this platform. The strength of the platform comes in when you are building a portfolio of portfolios. This is in the industry called fund of funds, where basically instead of trading one diversified portfolio, you trade multiple portfolios because of their unique specifications. So like I mentioned in the cluster tree analysis, you want to pick a fast momentum TAA portfolio and a slow momentum TAA portfolio with trend following timing TAA portfolio. So those have different characteristics. Yes, they all are mechanical, and yes, they all follow momentum, but they do it differently. So for example, the fast one uses the 1 month and 3 month momentum, while the slow one uses 12-month momentum. So you will have diversification even inside momentum. So that's the strength of this platform, to combine multiple portfolios. You have all the clean data, so you don't need to look and buy data to test, because you can test them easily and you can find the best allocation. So once you do that, you can actually change the allocation to suit your needs. So for example, here I built a portfolio of 4 portfolios, and then I just gave the current allocation, which is 25% each. And from that, then I will get these results. Okay, so this portfolio of 4 will give me 11.5% annualized return, 8% drawdown, maximum drawdown, and also performance index of 3.83. But let's say I want to change that. Even if I still want the same portfolios, I can also change the allocation per portfolio. So I can, for example, give the adaptive asset allocation. I can give it 40%. And then let's go 20 and 20 and 20. And now I change my KPIs based on that allocation. And of course, I can also change I can trade each model based on its best trading days. So for example, currently all these are trading on the 21st, so I can change this one to trade on the 19th and this one to trade on the 20th. And when I do that, the model will give me the allocation based on the day. So these allocations will change based on my trading day. So the flexibility is huge. I can tell you right away, I tried to replicate this without this platform, and it's extremely hard. Extremely hard to do it without basically having a platform to test. So they have done all the work. So that's benefit number 1, which is combining multiple portfolios, combining different trading day for each portfolio, and changing the allocation as per your need. Or if you want to change the allocation based on the environment you are in. And here is the other benefit of this platform. So this is a tax analysis. If you are trading your TAA portfolio inside a taxable account, then it's totally different than it's in a non-taxable account. See, capital gains is different, of course, it depends on the time you hold the asset class. So here in North America, long-term capital gains is a lot less than short-term capital gains. And here you can find that analysis. So short-term capital gain, if you sort by that, then you get a percentage of each strategy. And of course, long-term capital gain, dividends, interest, and long-term capital gains plus dividends. So you get the effect of each strategy on your taxable account and non-taxable account. Of course, if you are trading in a non-taxable account, then you're always looking for the highest return, or maybe highest ALSA performance index number, because that takes the drawdown into consideration. But if you're trading in a taxable account, then maybe the highest return is not the best, because if that strategy churning trades every month, then you're always striked with short-term capital gains, and you don't want that. Like a strategy that performs 10% annualized with long-term capital gains, it's much better than a strategy that performs 14% annualized at short-term capital gains. So you see, then your trading account taxable bracket makes a big difference, and this is a hugely missed point in the public domain. The tax effect on your return is huge, and you should take that into consideration. and the platform provides that for every single strategy. And then this is important for people who are reaching the retirement age where they can withdraw from their portfolio. And here, this is the safe withdrawal rate with zero inflation. I love this. So this is with zero inflation and with fixed 0.2 inflation. But this is actual. Actual meaning they take the actual data of inflation per year and they say, okay, well, which one is the safe to withdraw? And this is the median withdrawal rate, which is 5.2. And then the perpetual withdrawal rate is basically a more conservative rate. And in this case, the median is 4.8%. Again, you don't see this anywhere, at least anywhere, any of other tools that I've checked. This withdrawal rate, although it only affects retirees, but also affects you in terms of planning forward. Even if you are planning to retire in 10 years or 15 years, then the withdrawal rate will affect you. So you can plan it easier with this tool. And then we have some other unique measurements like exposure to rising interest rate. What this tells you, it ranked all the strategies based on their exposure to rising interest rates. So for example, this strategy has 77% exposure to interest rate. So if interest rate rises, of course, the effect on the strategy will be huge if it's 70% exposure. That means this strategy will underperform whatever the statistics in a rising interest rate environment. And again, you don't find this information, at least in the packages that I've checked. Exposure to rising US dollar. Again, it's the same like interest rate. So some strategies have a big exposure to US dollar, and therefore they will get affected when the US dollar goes up or goes down. So as you can see, it's an excellent piece of software. The service is extremely good, and I think the value for money is great. And of course, like I mentioned, I have a huge chunk of my investable dollars in tactical asset allocation portfolio. It's actually 3 portfolios into one, which I also have it in my Discord server, and you can follow those signals monthly there. So in today's age, actually, you have no reason at all not to be invested in a TAA portfolio instead of just dumping money in the S&P 500. I mean, that was good maybe 10, 20 years ago where we didn't know anything, or we didn't have the services available to us to do these kind of calculation or to get the signals relatively cheap. So, but nowadays there is no reason not to at least invest in one, like I showed you. Even if you pick all-weather portfolio, it already beats the S&P 500 long-term in any rolling period. Of course, if you have any questions, any comments, please do so below the video, and I'll be more than happy to answer you. And if you want to be part of my inner circle to receive the TAA portfolio signals, the stock portfolio signals, alongside the weekly live question and answer sessions where I answer questions more thoroughly in length, and of course everything is recorded for you to view it later, plus the many free downloads available in the server also, then you can join by following the Patreon link down below. As always, good luck with your trading, good luck with your investing, stay safe, and I'll see you soon.